America's CEOs think the U.S. economy is in or very near outright recession right now, at least according to BlackRock's own CEO, Larry Fink. And the Treasury market's inflation expectations absolutely agree, with those having crashed recently to new multi-year lows. Even Goldman Sachs has thrown in the towel, raising its own recession probabilities. And it's no wonder why, as the Federal Reserve reported, consumer credit appears to have cracked, furthering the distress in the consumer economy. While some markets are taking a break today from being liquidated, the recession warnings continue to roll in and pile up. And that's ultimately what will determine where things go from here. The risk off is coming from the R word, what has been seen as a rising probability. As late as a month and a half ago, that probability was widely thought somewhere close to zero, thanks to Jay Powell and last year's artificial high in the real economy. But as that high has come crashing down into the void of a payback, suddenly Powell's promised put looks a lot less viable. Markets have reacted harshly, only going from no recession to maybe this thing is real. But what happens if confirmation arrives, which shifts the thinking from this thing is real to holy crap, it's happening right now? But that's where we are in this process. Everyone now sees the possibility of a recession is significant. That means every changing market position or data report is even more important, as it might further confirm the global economy's current condition and therefore what that might tell us about the next step. And this is where the ongoing downgrade in market inflation expectations comes in, as does consumer credit, given how consumer spending is the one macroeconomic variable the entire financial world has leaned heavily on for all that prior complacency. The one thing that they thought made a recession so improbable it wasn't worth considering until very recently. Like I said, like it or not, everyone now has to consider those chances of an outright recession as being substantially high. Just how high will depend upon incoming macroeconomic data like consumer credit, as well as market positioning, such as the TIPS market, inflation expectations. America's CEOs already appear to consider it to be way too high right now. As was reported yesterday, BlackRock CEO Larry Fink said Monday that many business leaders believe the U.S. economy is already in a significant downturn. Quote, most CEOs I talk to would say we are probably in a recession right now. That's Fink talking at an Economic Club of New York event. One CEO specifically said the airline industry is a proverbial bird in a coal mine, a canary in the coal mine. And I was told that the canary is sick already. And we talked about this a couple weeks ago, back in the middle of March, back when we had a rash of airlines report that they were trimming their outlooks. They had said that something substantial had changed in February and March in particular. The one CEO called it a parade of horribles. Now, they tried to blame that on one-offs like weather and fires and other sorts of transitory disruptions, but apparently what they're telling Larry Fink of BlackRock, and he would know, he knows every CEO around, that it's not just a one-off, that it's not just a past tense parade of horribles, that the economic weakness in the consumer economy is hitting the airlines and it's spreading from there. But it wasn't a parade of horribles as he was trying to make them. As we see about a month later, it's only gotten worse, not better. There's more confirmation that the loss of momentum in the global economy and the U.S. economy has indeed impacted more and more sectors of it. I've talked about the services economy, the Fed regional surveys, the ISM non-manufacturing, employment indications, aside from the headline payroll number, the unemployment rate rising, and on we could go. But it's not just Fink or CEOs, even Wall Street economists are getting in on it too. Yesterday, Goldman Sachs Group economists raised their recession probability assessment and brought forward the forecast timing of the next Federal Reserve rate cut following the Trump administration's tariff announcements. Economists at Goldman Sachs lowered their 2025 Q4 to Q4 GDP growth forecast to just 0.5% from a full percent and raised the 12-month recession probability to 45% from 35%, at least according to their note dated April 6th. And 0.5% for the calendar year, that's well within recession territory. As I talked about in a recent video, anything less than 1.3% for a calendar year has, historically speaking, had a recession in that calendar year, either part of it or the entire year. So 0.5% from Goldman Sachs, along with some other indications and forecasts from Wall Street, and then this chatter from CEOs, The recession probability is a lot higher than people were thinking just a few weeks ago, and that's what's caught the markets off guard. And it's led to a tremendous amount of liquidations, margin calls, and the sell-offs that we see in the stock market, which will only get worse as more confirmation might come in, suggesting that the recession probabilities that now the markets are waking up to as being high, it's actually happening. That's the next step in the process here. But back to Goldman. In a recession scenario, we'd instead expect the Fed to cut by around 200 basis points over the next year. 200 more basis points. Our probability-weighted Fed forecast now implies 130 basis points of rate cuts this year, up from 105 previously, similar to market pricing as of Friday's close. And that puts the Federal Reserve, if it would happen, closer to where markets were pricing years ago, when everyone said this was crazy. The swap market back in 2023 had turned more and more confidently toward lower interest rates in the future. I did the chart that showed the swap market saying that interest rates, the 10-year nominal treasury rate was probably more fairly valued around 2% rather than say 5 and higher, as everyone was saying back in the higher for longer days. And higher for longer completely disappeared, just like the markets have been pricing all along. So as the Fed gets into more and more rate cuts, along with central banks around the rest of the world, showing that this is not about tariffs, this race to the bottom began last year. What we're seeing here are all the conditions that get the Federal Reserve further along in that race to the bottom that's already well underway. What the markets were saying back then, several years ago, while everybody was talking about higher for longer, was that the probabilities were all aligning that interest rates were going to go down. Now, we didn't know when and we didn't know how, but the markets were saying the conditions, the fundamental circumstances in the U.S. and global economy were not conducive for inflation or a soft landing or just a general boom period. What they were saying is that there was too many negatives that were continuing to pile up, that balance of probabilities, rates were going to go down, reflecting more likely than not negative outcomes. And here we are in 2025, and what do we see? We didn't know how, we didn't know when, but the negative outcomes are now being taken more seriously by more and more parts of the financial system, as well as even Wall Street economists, and you better believe central bankers too. But not according to Mr. Fink. Going back to Fink for a second here, he also said this notion that the Federal Reserve is going to ease, meaning cut rates 4 times this year, I see zero chance of that. I'm much more worried that we could have elevated inflation that's going to bring rates up much higher than they are today. And that's just complete and utter nonsense, because everything that we see suggests that rates are going to go down and likely stay there. Again, I just mentioned long-term market predictions, market forecasts, market positions from a couple years ago. They were warning this is the direction we were going to take. Not inflation, not an outbreak in inflation. If anything, we see the market saying those forecasts and predictions and probabilities that we priced years ago, not only they're coming true, we see more of them ahead. The market has not shifted from that point. So Fink's saying that inflation is going to be a big problem, rates are going to go up. Markets are saying nothing's ever zero probability, but that's as close to zero as you're going to get. Which brings us to Treasury Inflation Protected Security, or TIPS. These are the instruments that the government uses to pay inflation protection based on the CPI. So the market looks at consumer price expectations from the lens of macroeconomic fundamentals. What is the macroeconomy actually doing that could lead to higher price changes either in the short run or the long run? If there was real inflation, then there would be demand for this Treasury inflation protection. But what we see from the TIPS market is the exact opposite. For example, the 5-year forward inflation rate has just dropped to its lowest level since February of 2022. And these are long-run consumer price expectations. So this is the market thinking long-term, what is the fundamental conditions in the economy over now as well as into the future. Those sank recently to barely 200 basis points, which is where they were during the technical recession. If you remember back in 2022, it's not a technical recession anymore, but that's right when the economy shifted to forgot how to grow off of the price illusion high just before the invasion that spiked oil prices. And where the 5-year forward rate is now, this is low 2010s level. It's the same as 2019 or the middle of 2015. So talk about not inflationary. This is in the same area as the worst parts of the disinflationary half of the 2010s. So the five-year forward inflation rate comes from the TIPS market. And the TIPS, as I mentioned, those are Treasury securities that pay inflation, quote unquote, protection. And that protection is based on the CPI. So if the market believes the conditions in the real economy are shifting to create higher CPIs over the life of that instrument, the demand for TIPS will rise because the market will want to be protected from the consequences of those conditions that are being seen today if they're inflationary. And when that demand rises more than, say, nominal interest rates in the Treasury market for the same maturity U.S. Treasury rises, then the so-called break-even rate, which is the difference between those two, goes up. So the break-even rate is a derivative measure of CPI expectations in the Treasury markets, where we have higher break-evens, the more relative demand there is for this government protection, therefore higher price expectations being priced into the TIPS market. Now remember, don't take the TIPS market literally. If the TIPS break-even rate is, say, 250 basis points, that's not the market saying it expects 2.5% on the CPI. This is a measure of relative intensity for the demand for inflation protection. So break-even rates that go up mean a higher intensity and more sustained intensity for protection, demand for protection against consumer price rates going higher. Lower break-even rates mean the exact opposite, less demand for inflation protection. Now, normally break-even rates behave like the yield curve, which means that they're upward sloping. That means inflation expectations are believed to go higher over the long run. That's where the curve is, and that's where the market behaves in normal conditions. But starting in 2021, short-term break-evens soared far higher than their longer-run counterparts. And that meant the market was pricing, I'll say it, transitory price effects. That CPI protection would be needed more in the shorter maturities than those longer dated. And I often compare just the 5-year and the 10-year because those are the two maturities that go into the 5-year forward rate. And what you saw was the 5-year Treasury break-even go way higher than the 10-year. In fact, the 10-year was only brought up because of the 5-year. In other words, the market was saying we're going to need more inflation protection in the first 5 years than we would need in the second 5 years, which is the market saying transitory. And that proved to be the correct position, even as far back as 2021 and 2022. We saw the same thing happen last year. When oil prices spiked around February into March and April, we saw the TIPS break-evens invert then as well. The 5-year break-even went a little bit higher than the 10-year, which was the market saying that the oil price spike was not going to be inflationary. Its impact would be temporary on CPIs, and then more likely than not, the intermediate and longer-term consequences would be more disinflationary, more weakness in the real economy, producing disinflation than not. So you see inversion in the TIPS curve, that simply means short-run price expectations, long-run likely weakness. So what we've seen in 2025 is, again, the 5-year break-evens that went far higher with the prospect of tariffs being implemented. In fact, the 5-year break-even rate hit a 2-year high just a little while ago. Meanwhile, the 10-year break-even rate was largely steady as the 5-year and some of the shorter maturities were going much higher. So in other words, the break-evens inverted yet again. The market was expecting tariffs to create short-run price effects, but they would not last into the long run. Again, more demand for CPI-based protection in the short term than CPI-based protection for the long term. Contrary to what Mr. Fink was saying, the market is not pricing consumer prices are going to go up and stay up like they have in every inflationary 1970s style scenario that fills the imagination of all of these mainstream commentators. Instead, the market is pricing it like last year's oil price spike or even the big supply shock in 21 and 2022 as a temporary impact on CPIs, more demand for CPI protection in the short run, but then the consequences in the long run, as we see in the 5-year forward rate, being disinflationary because the economy cannot afford another rise in prices. And that the effect of that rise in prices will make a bad situation, a situation that's already bad and recessionary to begin with, that much worse. That's why the 5-year forward rate has fallen to a new multi-year low. That's the expectation in the market that the economy is more likely than not to get weaker and weaker and weaker, in large part because of the weakness in the economy to begin with, but also the price spike being one thing too many for it to handle. And that way, the long-run inflation expectations in the Treasury market have been confirming the disinflation parts of lower nominal treasury yields. And we've got a new low coming ever since the middle part of January, which is consistent with the breakdown in the economy, the parade of horribles, as Ed Bastian, the CEO of the airline, said, that has developed over the last several months. It's all consistent. It's not inflation, it's rising recession risk from all these different sides. So the tips message is that Fink is absolutely wrong about inflation, that if tariffs do create a price spike, it'll only be in the short run, and that long run, the consequences will be the same as the oil price spike that we saw last year, except in this case, when we throw in the liquidations from the stock market and the behavior in all these other markets like commodities, that any price spike in the short run will be the final straw that finally breaks the camel's back. And a lot of that has to do with the consumer economy. Because first of all, from the market perspective, the strong and resilient consumer, as we've heard endlessly for the last several years, has finally shown signs of breaking down. We see that in consumer sentiment, which is a reflection of labor market perceptions more than it is for spending. Same is true for consumer credit. What the Federal Reserve just reported for consumer credit in February was actually a decline in the seasonally adjusted estimated overall total balance in consumer credit across the entire U.S. economy. It actually declined by $810 million, which isn't a lot, but the fact that it wasn't growing by multiple billions is already a red flag. So a decline in total consumer credit suggests increasing weakness both on the side of borrowers as well as lenders. Lenders don't want to lend in this environment, certainly not with delinquencies rising, incomes falling, credit scores declining, and everything else that goes along with it. But while revolving credit tends to be the strongest cyclical signal, we've also seen a decline here in February in non-revolving credit, which is unusual to say the least, especially with interest rates declining. One reason why is there was so much artificial activity at the end of last year, including in consumer credit and non-revolving credit. What we see in non-revolving credit is a small decline in February after the slowdown last summer, September and October. Then the pickup in November and December, largely as auto loans increased as Americans tried to buy as many cars as they could before the tariffs hit. Then the slowdown in January, and then the downturn in February. As well as revolving credit. As I mentioned, revolving credit, a cyclical signal. Revolving credit was basically flat, the seasonally adjusted overall balance, flat in February after being down sharply in November. That was a key warning back then. It bounced back in December, likely in December, though we don't know how much with the discontinuity, as well as in January, but then again flat here in February. So you even got consumer credit tracing out the same artificial high last year, and then the payback, the sharp loss of momentum, the parade of horribles. So you've got consumer credit, you've got consumer sentiment, you've got labor market concerns, you've got the tips market and long-run inflation expectations that are dropping. Suddenly, the recession probabilities that were already starting to pick up really do start to look substantial. One of the reasons revolving credit is such a key cyclical signal is that it corresponds pretty strongly with the unemployment rate, which makes a whole lot of sense. You're not using your credit cards when unemployment is rising and uncertainty over jobs and incomes goes way up beside it. So the next big thing here is markets getting more and more confirmation that the recession probability might not actually be a probability, might actually be happening. So what happened in the marketplace up to this point was being shoved off of strong and resilient, nothing bad can happen, to holy crap, this recession scare is a little bit stronger than a scare. That forced liquidations because, as we know, in the stock market, stocks don't like recessions. The prospect of recession, even a tiny increase, a substantial increase in recession probabilities means sell stocks. So the probability in the marketplace picked up because that's where a lot of things have been heading. And tariffs have refocused everyone's attention on those recession probabilities that are far stronger than anyone wanted to admit beforehand. But now we're looking forward from going from, okay, recession's a real possibility to maybe it's an exceptionally high possibility. And as we get more and more confirmation, assuming we do, and that's what we keep getting from the marketplace as well as the economic data, the more confirmation that we get that the probability is exceptionally high, the worse it's going to be in the marketplace. Stocks, high yield credit, currency markets, and a whole bunch beside. All the typical traditional recession processes that end up playing out, potentially including collateral, monetary difficulties on top that could amplify the signals as well as the consequences from the recession economy. All of that becomes in play. That's what CEOs are saying. That's what Wall Street economists are saying. You better believe it's what central bankers are saying in private. That's why they're heading toward the race to the bottom. And that's what the markets are picking up on. All of them, stocks as well as tips and all the stuff in between. And then on top of all that, we've got the possible amplifying negative of the AI bubble reversing. And that's what I talked about in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. Until next time, take care.